There are 58 monthly dividend stocks available to you right now. 58 options promising income every single month instead of every quarter. Some of them yield above 20%. And if you have ever looked at that number and felt your pulse quicken even slightly, I need you to stay with me for the next 8 minutes. Because what is hiding underneath those yields is not income, it is a countdown. And most investors do not realize they are watching one until the payments have already stopped arriving. Let me start with the thing that breaks the entire top of this list before we even get past the first column. Yield percentage is calculated by dividing the annual dividend payment by the current share price. That is the entire formula. Which means when a share price falls, not because the company got more generous, not because the business improved, but simply because the stock dropped, the yield percentage goes up automatically. The highest yields on any dividend list are very often just the stocks that have fallen the furthest. The income looks bigger because the investment got smaller. That is not a reward. That is a warning dressed in attractive clothing. Then there is the payout ratio. This number tells you what percentage of actual earnings a company is paying out as dividends. When I looked at the stocks sitting at the very top of this list sorted by yield, what I found behind those 20, 30, 40% yields were payout ratios of 813%, 346%, 244%. A payout ratio above 100% means the company is paying out more than it earns. It is not running a dividend. It is running a scheduled return of your own capital while the business underneath quietly deteriorates. That is not income investing. That is a slow, polite liquidation with monthly branding. So I set 3 rules before touching a single name on this list. Not guidelines, not preferences. Hard rules where failing even one meant immediate removal regardless of how attractive the yield looked. Rule 1. The dividend must be covered by what the company actually earns. Payout ratio above 100% is not a yellow flag. It is an automatic disqualification. A company paying out more than it generates is not running a sustainable income business. It is running a countdown to the day it cannot. Rule 2. The stock must have paid through at least one major recession without cutting the regular dividend. 2008 and 2020 are the 2 tests that matter. If a company could not hold the payment when everything was falling apart simultaneously, there is no logical basis for trusting it to hold through 30 years of normal economic life. Rule 3, the dividend must be growing. A 10% yield that stays perfectly flat does not keep pace with inflation. The income has to expand. 10 consecutive years of dividend growth is the minimum threshold. I worked through all 58 names with those 3 rules running simultaneously. The top of the list cleared itself almost immediately. NLOP, ECC, SPMC, HRZN. Massive headline yields with almost nothing behind them in earnings. Some carried no measurable payout ratio at all because there were no earnings to measure against. They were gone before I finished the first column. SCM had a past performance score of 0 out of 6 across every single metric. Shareholder return down 34% while the broader market was up 16%. That is a stock returning your capital to you in small monthly installments while the position collapses underneath the payments. SBR stayed on the list longer than most. The yield looked genuinely strong. Then I checked what actually drives the payment. Sabine Royalty Trust distributes based directly on what oil sold for. There is no dividend policy, there is no earnings coverage, there is no cash flow buffer. When crude dropped in 2020, the payout dropped with it, simply because a commodity price moved, removed. Realty income carries more respect than almost anything else on a monthly dividend list. 6 out of 6 on every dividend quality metric, 669 consecutive monthly dividends paid. Then I checked the one number that screen does not show prominently. 10-year share price appreciation is negative. The income stream is as reliable as anything in this market. The capital sitting behind it goes nowhere over a decade. That gap compounds into a real problem across a long enough timeline. Set aside. Glad failed in under 30 seconds. Payout ratio of 122%. Paying out more than it earns, down 37% while the market was up 16. Rule 1 fails. CSWC was the hardest cut on the entire list, 11.9% yield, 12% dividend growth rate over 10 years. Those 2 numbers together are better than almost anything remaining. I almost stopped here. Then I pulled the full dividend history. The chart starts in 2016. The question that kept returning was simple. Where is the 2008 data? There is none. CSWC was not running this strategy in 2008. It never faced that test. I will not trust a 30-year position to a company that has never been tested. One company on this list was paying monthly dividends through 2008, through 2020, through every market cycle. Never cut once. Main Street Capital, ticker MAIN. Here is what most investors do when they see the label Business Development Company. They stop reading. They should not. What a BDC actually does is straightforward. Thousands of small and mid-sized businesses need capital to grow. They are too small for Goldman Sachs, too established for venture capital. The banks want collateral they do not have. Main Street steps in, provides the financing, and charges for it. That is the core business. What separates Main from the majority of BDCs is the structure of how it earns. Most BDCs lend money and collect interest, one income stream. Main does that. But it also takes equity stakes in some of the companies it backs, capturing that upside. Interest income on one side, equity appreciation on the other, two separate engines generating returns simultaneously. The share price reflects both, up over 250% since Main went public and 71% over the past 10 years. The dividend chart goes back to 2007, the year Main went public, monthly payments through 2008 through 2020. Every single month without interruption, without a cut to the regular dividend. The NAV per share, the underlying book value, started around $12 in 2007 and sits at $34 today. The two engines show up in the actual numbers across 19 years of real market history. Main is also internally managed, meaning the people running it are employed directly by the company. That is genuinely rare. It keeps significantly more of the income where it belongs, in the dividend rather than in an external manager's fee structure. Beyond the regular monthly payment, Main periodically issues supplemental distributions, bonus payments on top of the base. The regular monthly is the floor. The supplementals are everything above it. Forward dividend yield of 8.38%. Dividend growth averaging 3.69% annually over the past decade. Share price appreciation at 5.12%. Coverage ratio of 132%, meaning Main earns $1.32 for every dollar paid. That coverage is what separates a sustainable payment from a countdown. I am not going to pretend there are no concerns. The share price has dropped from $67 12 months ago to $52 today. The BDC sector has been under pressure from nervousness about private credit and AI disruption. The business did not change. The price followed the sector down. Wall Street's current consensus is hold, not a strong buy. Analysts are debating valuation relative to book value, not dividend safety, not business quality. Short interest sits at 8.6%, meaning professional investors are actively betting against it right now. I do not ignore it. But I am not buying Main for next quarter. I am building a position for a decade-long calculation. Here is what that calculation actually produces. $10 a day invested into Main, dividends reinvested monthly. Across 30 years. By the end of year 1, $3,650 deployed. By year 10, the portfolio is projected at $66,594 with annual dividend income of $4,119. By year 20, the projections show $268,816 in portfolio value, generating $15,159 annually. By year 30, $824,858 in total portfolio value with annual dividend income of over $40,000. That is $3,414 arriving in your account every single month from an initial commitment of $10 a day. The compounding acceleration across each decade is not a quirk of optimistic assumptions. It is the result of monthly reinvestment, running 3 times faster than quarterly reinvestment on the same underlying yield and growth rate. Every monthly payment buys more shares. The engine gets faster because it is turning over more often, and time gives each rotation more mass to compound on top of. $10 a day, 30 years, a business that has never cut its monthly payment through any market environment that tried to force its hand. That is the entire thesis.